This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Choppy start. Stocks continue their recent volatile ways to start the week and appear unfazed by this past weekend's bombings.
Confidence surges. Home builders are feeling better than they have in almost a year, as home buyers appear more eager than ever to sign on that dotted line.
Talking a big game, why Oracle's Larry Ellison is making a brash prediction and attacking Amazon in the process. Those stories and more tonight on Nightly Business Report for Monday, September 19th.
Good evening, everyone, and welcome. A major breakthrough in the New York and New Jersey bombings. We'll have more on that a bit later in the program. But we begin with the volatile start for the week for stocks. Early on, the blue chip Dow index rose triple digits, but the gains were cut in half by midday, only to rise again and then drift downwards into the close. On the day, the Dow Jones Industrial Average lost 3 points to 18,120. The Nasdaq was down 9, and the S&P 500 fell just a fraction. The initial gains were driven by a jump in the price of oil and a very strong report on the housing market. But when oil turned, so did stocks, making it quite clear that the price of crude matters now more than usual. And oil prices settled slightly higher as traders hold out hope for a deal that would freeze production.
Well, that strong housing report that Sue just mentioned saw confidence among home builders rise to its highest level in almost a year. That helped home building shares like those of Lennar, D.R. Horton, and Pulte rise during trading today. Diana Olick takes a look at what's driving the surge in one of the economy's most important sectors.
The sales offices at EYA, a developer in the D.C. metro area, were very busy this summer. Busier, in fact, than usual.
That really started in July and carried into August. It was surprising relative to what we've seen in the past.
As both jobs and incomes improve, buyers are more enthusiastic and more serious about signing on the dotted line. But there may be something else behind the rush to buy.
I think people have felt that interest rates have been low for a long time, and there's fear that eventually interest rates will rise.
Home builders are seeing it across the nation. A monthly index of builder sentiment jumped by a far wider than expected margin in September, with builders citing big gains in current sales and sales expectations over the next 6 months. Builders may also be benefiting from a lack of supply of existing homes.
It's not that people aren't listing so much. It's that there are new buyers and more buyers on the scene now than there were a year ago. Every well-priced home gets snatched up. There's multiple bids.
Builders say they're confident of demand but struggling to keep up with it. A shortage of land and labor are increasing costs for the builders, and regulation is slowing construction. Some of the nation's largest housing markets are in most dire need of new construction, according to a new report from the Realtors, which shows the top 10 cities where supply is tightest. The West is worst, accounting for half the list.
Traffic was way up, and so we saw people, coming in multiple times, spending more time in the model homes.
And he's hoping that enthusiasm keeps going right into the fall. For Nightly Business Report, I'm Diana Olick in Chevy Chase, Maryland.
Today kicked off the first of several readings on the housing market. Tomorrow, we'll get housing starts, and a bit later in the week, we'll get existing home sales. But will it continue to be good news for the housing industry? Senya Goodell, chief economist at Zillow, joins us now to talk about that. Senya, welcome. Nice to have you here.
Thank you very much.
Let's start, first of all, with that basic question. I mean, things seem to be not only improving, but going pretty darn well. Do you expect that to continue?
I do expect that to continue, and I think the sentiment numbers that we saw come out this morning really underline what we've been seeing in the market, and that's new home sales have been doing really well. Existing home sales have been stepping aside, and so new home sales have been filling that void as inventory has been relatively tight across the nation, and so builders have been trying to keep up and fill demand that is quite strong.
Is there any bad news in the housing market in terms of pricing?
Well, it depends on which chair you're sitting in, I guess. As a buyer, it's a fairly competitive environment out there, and it's hard to actually find a home. It's hard saving for that down payment, and we're seeing home values continue to creep up. We have home values up roughly 5% annually right now at Zillow, so it's fairly steep home value appreciation. And so for some buyers, it's actually fairly tough to break into that homeownership space because they're paying relatively higher rents and are having a hard time saving for a down payment and then actually being able to find that affordable home.
Now, they've also been helped a little bit by lower interest rates, historically low interest rates. The expectation is before the end of the year, one way or another, we'll see the Fed hike rates perhaps just a quarter point or so. Will that have a meaningful impact on the housing market, or is it not as significant point increase?
I think in general, it's not going to have a significant impact. If you can't afford a mortgage payment today, you probably won't be able to afford a mortgage payment, after that rate hike either. So that doesn't change the situation much. However, I do think as we start to see more of these rate hikes and rates will essentially come back up again, we will start to see markets like San Francisco, Denver, even Seattle that are more expensive markets. They'll start to see a bit of a dampening effect on demand because housing will end up being more expensive then.
All right, we'll leave it there, Senya. Thank you very much.
Thank you.
Senya Goodell with Zillow.
Well, a rare change is happening to the S&P 500. The index is getting its first new sector since roughly the dawn of the dot-com era. Real estate investment trust, REITs, one of the hottest investments of the past decade, now will have their own classification. How nice. Bob Pisani walks us through the change and what it means to investors like you.
The S&P 500 is getting a facelift for the first time in almost 20 years. Since 1999, the S&P has been divided into 10 sectors, including technology, financials, healthcare, and energy, among others. But starting today, there's an 11th sector, REITs, or real estate investment trusts. REITs are stock companies that own and operate real estate on behalf of their investors. Everything from shopping malls to office buildings to personal storage units. There's been growing interest in investing in real estate as a separate asset group, particularly since REITs throw off high dividends that are very attractive in a low interest rate environment. The 27 REITs in the S&P 500 have outperformed the broader market this year. REITs were part of the financial sector, but it never made much sense to include them in that group. Real estate has different investment characteristics than bank stocks, for example. So for all the above reasons, Standard & Poor's has created an 11th sector for REITs. REITs are now 3% of the weighting in the S&P 500. That doesn't sound like much, but materials, telecom, and utilities are also 3%. Of course, real estate investors are hopeful that this will spark even more interest in investing in this asset class. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
The commercial real estate market is one reason why the president of the Boston Fed wants the central bank to act. According to the Wall Street Journal, Eric Rosengren says that the soaring market for office and apartment buildings is being driven in part by a scramble for returns. Rosengren, who had been an advocate for easy money policies, reversed course recently and said it's those policies that could allow the markets to get out of hand. The Fed's two-day policy meeting starts tomorrow.
Investors will also watch Japan's central bank. It meets this week, and policymakers there are likely to boost economic stimulus. Ahead of the meeting, Prime Minister Shinzo Abe addressed investors in New York City and talked about the economic advantages of trade deals like the Trans-Pacific Partnership, or TPP.
Japan and the U.S. must each obtain domestic approval of the TPP as soon as possible for its early entry into force. Success or failure will sway the direction of the global free trade system.
The TPP is a major part, of course, of President Obama's strategy in the Asia-Pacific region, but its passage faces an uphill battle in Congress.
And now to the story that's on almost everybody's mind, the bombings in New York City and New Jersey. This evening, authorities have a man in custody. Morgan Brennan has more from the Chelsea neighborhood in Manhattan.
The suspect of this past weekend's bombings in New York and New Jersey, Ahmad Rahami, has been apprehended. He was taken into custody after engaging in a shootout with police in Linden, New Jersey. He was shot several times but was conscious at the time of arrest. Still, the investigation continues, despite law enforcement officials saying there are no other individuals that they are looking for at this time. Now, here on 23rd Street, where a bomb exploded Saturday night, injuring 29, the FBI swept the street for clues this afternoon and carted away the green dumpster in which a pressure cooker device detonated. New York's Mayor Bill de Blasio officially labeling the incidents in New York as acts of terror at a press conference this afternoon, and FBI Special Agent William Sweeney linking the incidents here in New York to the Saturday morning bombing in Seaside Park, New Jersey.
The work of the first responders, law enforcement personnel, and the contributions of an engaged public have been exceptional.
President Obama, who spoke earlier today, offered federal support to New York and New Jersey in their ongoing investigations.
By showing those who want to do us harm that they will never beat us, by showing the entire world that as Americans we do not and never will give in to fear, that's going to be the most important ingredient in us defeating those who would carry out terrorist acts against us.
The president is in New York for the United Nations General Assembly, which kicked off today. Security in the city, which is already stronger than usual, has been dramatically boosted in the wake of this past weekend's events. For Nightly Business Report, I'm Morgan Brennan in New York City.
The market's reaction to the Manhattan bombing just blocks from the NYSE and NASDAQ was remarkably restrained today. Here to explain why and to look ahead to this week's market moving events is Stephen Wood, Chief Market Strategist at Russell Investments in Seattle. Stephen, welcome. Good to have you with us. Can we say that the market's relatively restrained response today is because the market has become inured to these kinds of terror attacks? It's priced them in?
I think that's a reasonable assessment. I mean, these acts are very nerve-wracking. They're terrible. They're unspeakable acts. But we've also seen many of these, whether that's San Bernardino, London in 2007. So for the better part of a decade and a half, this has been something of a new reality. And markets tend to respond very quickly, not only to these kinds of headlines, but political headlines. So the headline risk that drives markets tends not to stick around for very long. And I think that the market is probably appropriately looking more towards the fundamentals, the Federal Reserve, the economy, the earnings season. So while these are terrible, awful acts, the market seems to have priced this in as part of the environment.
So let's turn to the Fed. What do you expect from the Fed? And we've seen a lot of volatility every time we hear a Fed president speak. Do you expect that volatility to continue?
I think what the Fed is going to do this week is they're going to firm up their perspective. The Fed has been debating whether to raise rates, when to raise rates, because we've come through a very traumatic time. But the data in the U.S. have been improving for a while. So they've gone from this very dovish or accommodative or easy stance, and they want to leave open their flexibility. So we think that this week they're going to tighten up their language, not raise rates this week in September. And what they're going to do is probably look towards December, and we expect a raise coming from the Federal Reserve at the end of this year, not this week, but the end of this year. So they're going to tighten up their language a bit as the data improve in the U.S.
What does 2017 look like to you with respect to interest rates? More hikes or just one in next year?
Sure, the expectation is for one, maybe two in 2017. I think 2 rate hikes in 2017 would be coming from very good data coming out of the U.S., but also good data coming out of Europe and the Bank of Japan. And one of the things we see now is that as the data improve and monetary policy tightens up a little bit in the U.S., the European Central Bank, the Bank of Japan, they're running the exact opposite direction as fast as they can. So it's more of the international data that are kind of holding the Fed a little bit lower. But it could be 2 rate hikes, but we think one is already priced into the market for 2017 as well.
How do you feel the market is going to perform for the rest of 2017, if indeed that rate hike, 1 or 2, is priced in?
Yeah, we don't have a formal forecast for 2017 just yet for the U.S. market, but what we do see in the U.S. is a choppy, sideways-ish market for 2016. The valuations in the U.S. market look rather rich. So what we're telling clients is that, we're not calling for a recession. We don't think it's a look up below situation, but valuations ultimately matter. A more global, multi-asset, diversified perspective we think makes sense. Look at Europe, look at Japan, but multi-asset, global, and we think an active environment right now is called for investors as, return is more and more hard to find.
Right. All right, Stephen, thank you very much. Stephen Wood, Russell Investments.
Thank you.
And still ahead, big prediction why Oracle thinks it can win and crush the competition in one of tech's hottest businesses. Donald Trump's tax plan would reduce taxes and help the wealthy. According to analysis by the conservative-leaning Tax Foundation, the Republican nominee's new plan would reduce federal taxes by between $4.4 trillion and $5.9 trillion over a decade. The range there is due to conflicting statements on business taxation. The wealthiest 1% would see their after-tax income increase by about 10%. The total cost of the latest plan is less than the $10 trillion price tag on the original one.
An update now to that shipping story we've been following. Nearly a third of Hanjin's container ships have unloaded their cargo. That eases some concerns among retailers, most especially, that they now expect to get a portion of their products in time for the holiday season. According to the company, 28 vessels have unloaded goods at ports around the world, including in California. Hanjin, the world's 7th largest shipping company, filed for bankruptcy last month.
Gas prices have started to spike in parts of the country, as we told you they likely would. According to AAA, gas prices were up 21 cents in Georgia, 16 cents in North Carolina, and 13 cents in Tennessee since last weekend. A portion of the Colonial Pipeline that carries gas to much of the Southeast and East Coast has been shut down because of a leak, preventing gas from getting to where it needs to go. Construction on a bypass is expected to be finished this week.
Thousands are gathering in San Francisco for the world's largest enterprise technology conference. And some of the biggest players in the industry were talking about one topic in particular. John Ford has the big buzz from Oracle World.
A decade from now, 80 cents out of every dollar that businesses spend on technology will be spent on cloud computing. That's the latest prediction from executives at Oracle, who have gathered business customers from around the world to San Francisco this week. So, naturally high on co-founder Larry Ellison's agenda, making the argument that Oracle will have one of the best clouds to buy. Oracle announced new versions of its database software and infrastructure and promised to start releasing new software features first in the cloud, then in traditional channels.
Amazon's lead is over. Amazon's going to have serious competition going forward.
The cloud can be tough to understand, but it comes down to this. Businesses aren't paying for technology the way they used to. They're not just buying big servers, databases, and apps every few years and paying an army of workers to keep it running. Instead, they're increasingly paying Amazon, Microsoft, Oracle, SAP, and others a steady subscription fee to own and update the expensive data centers and simply deliver the needed services. As a result, there's a massive gold rush happening in the technology world. It's not yet clear how things will end up, but it's possible that a few companies who once dominated small yet profitable bits of tech spending will use the cloud to suck in bigger, equally profitable chunks and crush competitors along the way.
Several years ago, we made the decision as part of this overall strategy to go all in on the cloud. We changed our organization to do that. We changed our incentives to do that, in addition to releasing a lot of great products. In Q1, our cloud growth in dollars, combined with our new software license dollars, grew 16%. So really, to us, it's the combination of those two that are important, and the fact that cloud growth was so high. I mean, we grew our cloud in Q1 82%.
It's by no means a clear path for companies like Oracle. Besides the other tech giants, they're also looking out for companies like Salesforce and Box and Workday that are forming their own alliances and fighting for their piece of a cloud pie that Gartner Group says is going to be worth more than $200 billion in 2016 alone. For Nightly Business Report, I'm John Fort in San Francisco.
Sarepta Therapeutics treatment for Duchenne muscular dystrophy gets the green light. And that's where we begin tonight's market focus. The Food and Drug Administration granted the biotech company's drug accelerated approval status, making it the first approved treatment for the fatal disease. As we recently told you, a vocal critic of the medication left the Food and Drug Administration last week. Shares soared nearly 74% to $48.94. Casino operator El Dorado will buy rival Isle of Capri casinos for about $950 million. El Dorado said the merger will allow the company to expand its geographic presence. Isle of Capri shares popped 30% to $22.04, while shares of El Dorado fell nearly 3%. Tech Data will buy Avnet's Technology Solutions division for about $2.5 billion. That deal is expected to create a one-stop shop distributor for consumer technology and data center hardware. Tech Data also said the transaction will help its earnings and result in significant cost savings. Shares of Tech Data popped 22% to $84.80. Avnet rose nearly 7% to $41.89. And another technology deal as well. Network security company Infoblox will be acquired and taken private by Vista Equity Partners for more than $1.5 billion. The private equity firm will pay $26.50 a share for the company, and that is about a 16% premium to Infoblox's closing price on Friday. Today, Infoblox was up nearly that much, closing at $26.35.
And GoPro launched the latest two versions of its signature camera line and unveiled its first drone. It's called Karma. CEO Nick Woodman thinks Karma could be a game changer for the company.
I think that Karma is the most exciting addition to GoPro's product lineup. I think it's the most exciting product we've ever made. It's certainly the most enabling product in terms of helping people capture incredible professional quality footage of their lives and share stories like they're used to seeing on the big screen at the movies. So given that that's what GoPro's brand has been built on, I think Karma's got a really good shot at being very successful.
And GoPro edged up a little more than 2% to $15.31. SeaWorld will cut its quarterly dividend by more than half. The dividend was cut from 21 cents a share to a dime, 10 cents. The theme park operator said that once the dividend is paid to shareholders in October, done. All quarterly dividends thereafter suspended indefinitely. SeaWorld was up 7 cents on the day to $12.69, but got hit once that news came out after the bell. And the women's specialty retailer Ascena got hammered after hours following disappointing guidance for 2017. The company also reported weaker than expected earnings for the current quarter, but did manage to top analyst sales expectations. Shares initially fell more than 20%. Look at that one after the news hit, wiping out a 2% gain in the regular day session, during which it closed at $8.12.
The opioid industry ramped up political spending over a 9-year period. According to analysis by the Associated Press, between 2006 and 2015, members of a little-known group called the Pain Care Forum spent more than $880 million on campaign contributions and lobbying at the state and federal levels. According to the report, that's more than what the powerful gun lobby spent on similar political spending. The goal was to fight laws that would limit the availability of opioids. The Pain Care Forum is described as a loose network of pharmaceutical companies and allied groups. Sales of opioids quadrupled from 1999 to 2010. Overdose deaths rose about the same rate.
And still ahead, misfit stock? Why does the most valuable publicly traded company in the world have a hard time fitting in?
Here's a look at what to watch for tomorrow. Wells Fargo's chairman and CEO will testify before the Senate Banking Committee on the fake accounts scandal. The Federal Reserve begins its 2-day policy meeting to determine the direction of interest rates. And FedEx, often viewed as a barometer of the global economy, reports its earnings. And that's what to watch for on Tuesday.
Apple, it's the world's most valuable publicly traded stock. Its iPhones and iPads are high-ticket goods that many view as necessities. And Apple is owned by millions, if not directly, then as part of a mutual fund or ETF. So why does a stock everybody seems to know defy easy categorization by investment pros and individual investors alike? Mike Santoli explains.
Apple is the world's most valuable company, but its stock just might be the market's ultimate misfit. Though Apple's market value exceeds $600 billion and it makes up more than 3% of the S&P 500 index, the stock does not behave much like a true market bellwether. Apple's stock moves tend to be independent of economic data or broad market trends. While the stock has been virtually flat the past 4 years, the S&P 500 is up 50%. Yet in a soft patch for the major indexes last week, Apple shares gained a quick 9%. Another indication of Apple's misfit status, it is a cheap value stock attached to a business that still plays by growth company rules. Many investors take comfort in Apple's modest valuation compared to the overall market, yet very few companies of Apple's size have ever been so dependent on new hit products rolled out over a punishing 2 or 3 year cycle, the way Apple rises and falls with the latest iPhone launch. Investors seem unwilling to put a higher price on each dollar of Apple's earnings without the confidence that its profitability can be maintained. Finally, Apple shares managed to be both excessively loved and somewhat neglected by Wall Street. Among the 40-plus analysts who cover the stock, more than 80% rate it a buy. Yet professional stock pickers as a group seem to have sold the stock heavily in the first half of this year, leaving more of the shares in the hands of index funds. This might help explain the stock's recent strength on better than expected sales of the new iPhone 7. As the shares began to perk up, many fund managers felt the need to get more exposure to the market's biggest name. None of this offers a clear outlook for the stock. If Apple were to approach the high end of its 5-year valuation range based on forecast earnings for the next year, the stock would rise from $114 toward its former peak around $130 a share. Yet the best bet might be for Apple's performance to remain streaky. That could mean its recent rally was just another passing phase of popularity for a widely watched stock that just can't seem to fit in. For Nightly Business Report, I'm Mike Santoli at the New York Stock Exchange.
And that does it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for watching.
And thanks from me as well. I'm Tyler Mathisen. Have a great evening, everybody. We'll see you back here tomorrow.